At 3:47 a.m. Eastern Time on January 15, 2026, while most Americans slept, the global financial system changed forever. No announcement came from Washington. No emergency meeting convened at the Federal Reserve. No headlines screamed across morning television. The revolution happened in silence. In a coordinated digital deployment across 9 time zones, the BRICS nations activated their new international settlement system. Brazil, Russia, India, China, South Africa, Saudi Arabia, Egypt, and Ethiopia simultaneously switched on infrastructure that renders the US dollar optional for the first time in 80 years. They called it the unit, but they should have called it the end. Within hours, $2.3 trillion in daily trade flows began moving through pathways that bypass every American bank, every Western clearinghouse, every dollar-denominated system that has controlled global commerce since World War II. Oil from Russia to India, manufacturing goods from China to Brazil, agricultural products from Egypt to Saudi Arabia, all settling in a currency system designed to function independently of Western control. The monopoly that has funded American supremacy for 8 decades shattered overnight. Not through war, not through sanctions, not through political pressure, through pure mathematical elegance and technological superiority. And the most terrifying part? It works perfectly. Walk through the halls of the Federal Reserve Building in Washington, and you'll find economists scrambling to understand systems they didn't see coming. The assumption that underlied every policy decision for generations, that global trade must flow through dollar markets, evaporated while they debated interest rates and inflation targets. For your entire lifetime, the US dollar has been the undisputed king of international commerce. Every major transaction, from oil purchases to bond issuances, required conversion into dollars at some point in the settlement process. This created artificial demand that kept dollar values high and American borrowing costs low, regardless of fiscal policy or economic fundamentals. That artificial demand just disappeared. The architecture of revolution. The BRICS unit isn't just another digital currency experiment. It's a complete parallel financial architecture designed by mathematicians who understood exactly what they were destroying and exactly what they were building to replace it. The system operates on 2 revolutionary principles that make traditional banking infrastructure obsolete: gold backing and algorithmic sovereignty. 40% of every unit's value is anchored to physical gold, held in secure vaults across member nations. Not paper gold certificates, not ETF shares, not derivative contracts, physical metal that can be audited, verified, and transferred. When you hold units, you own a mathematical claim on real gold, sitting in real vaults, protected by nuclear-armed governments. This isn't monetary theory. This is monetary engineering. The architects studied every currency collapse in history and designed countermeasures for each failure mode. Hyperinflation becomes impossible when 40% of value derives from scarce metal. Government manipulation becomes limited when algorithms control issuance. Political weaponization becomes difficult when no single nation controls the infrastructure. The remaining 60% derives from a weighted basket of member currencies. But here's where the genius becomes apparent. The weighting adjusts automatically based on economic performance, trade volumes, and resource contributions. Countries that produce more goods get more influence. Nations that contribute more resources gain more weight. Economic reality determines monetary authority rather than political negotiations or military threats. This creates a currency that strengthens as its members' economies grow and weakens only if all members simultaneously decline. Compare this to the dollar, which weakens every time America prints money, but maintains artificial strength through forced global adoption. But the real revolution lies in settlement speed and cost structure. Traditional dollar-based international payments require multiple intermediary banks, currency conversions, and compliance checks that can take days and cost hundreds of basis points. Unit transactions settle in minutes, with costs measured in fractions of pennies. The efficiency advantage is so overwhelming that businesses adopt the system purely for economic reasons, regardless of political preferences. When you can save 2 to 3% on every international transaction, while reducing settlement time from days to minutes, the choice becomes obvious. The silent deployment. What makes this transformation historically unique is how quietly it occurred. Previous challenges to monetary systems announced themselves through dramatic political speeches, military threats, or economic summits covered by global media. The BRICS deployment happened through infrastructure construction, disguised as routine technological upgrades. Digital payment systems, blockchain networks, trading platforms, clearing mechanisms. Each component appeared innocent individually, but combined into a complete alternative to Western financial architecture. By the time Western intelligence agencies recognized the scope of what was being built, the construction was finished. The system was tested. The infrastructure was hardened against cyber attacks, economic warfare, and political interference. The deployment was irreversible. The coordination required for this achievement demonstrates planning that began years before public announcements. Central banks that spent decades accumulating gold suddenly made sense. Trade agreements that seemed economically marginal suddenly revealed strategic purpose. Currency swap arrangements that appeared defensive suddenly looked offensive. Every puzzling decision by BRICS nations over the past 5 years can now be understood as preparation for this moment. They weren't reacting to American policies, they were building the infrastructure to make American policies irrelevant. The mathematics of monetary revolution. The numbers that matter aren't the daily price fluctuations or trading volumes that dominate financial media coverage. The numbers that matter are structural and permanent. BRICS nations control 40% of global GDP, 45% of global population, and 60% of global commodity production. More importantly, they produce the physical goods that other nations need, while consuming relatively fewer financial services that other nations provide. When manufacturers don't need dollars to buy raw materials, demand for dollars decreases. When oil exporters accept payment in units, demand for dollars decreases. When agricultural exporters price grain in units, demand for dollars decreases. Each transaction that shifts from dollar settlement to unit settlement reduces the artificial demand that has supported dollar strength for generations. This isn't a gradual process measured in decades. Modern digital payment systems enable rapid adoption when economic incentives align. Countries facing dollar shortages can access unit liquidity immediately. Businesses facing currency volatility can settle in units instantly. Governments facing sanctions can trade through unit networks continuously. The tipping point mechanics are already visible in real-time data. Russia and China conduct 90% of bilateral trade in non-dollar currencies. India and Russia have eliminated dollars from energy transactions. Saudi Arabia accepts yuan for oil payments. Each precedent makes the next adoption easier and more logical. But the acceleration phase begins when smaller nations recognize the advantages and join the system voluntarily, rather than waiting for political permission or economic crisis. When Indonesia, Nigeria, Bangladesh, and similar economies start settling significant trade flows through units, the mathematical pressure on dollar demand becomes overwhelming. The psychological warfare. The most sophisticated aspect of this monetary revolution involves the psychological conditioning that makes resistance seem irrational rather than patriotic. Western media coverage focuses on technical details, regulatory concerns, and geopolitical implications, while ignoring the practical advantages that drive adoption. This creates a narrative that unit usage represents political opposition to America, rather than economic optimization for business efficiency. But businesses don't care about geopolitical narratives when they can reduce costs and improve efficiency. Countries don't prioritize monetary loyalty when they can improve trade balances and economic sovereignty. Central banks don't maintain reserve currencies based on political preference when better alternatives become available. The BRICS architects understood that monetary adoption follows economic incentives, regardless of political messaging. They made unit usage profitable rather than ideological. They created practical advantages rather than theoretical benefits. They solved real problems rather than imagined grievances. This approach neutralizes the standard American response playbook, which relies on political pressure, economic threats, and alliance coordination. How do you pressure businesses for choosing more efficient payment systems? How do you threaten countries for reducing transaction costs? How do you coordinate allies against superior technology? The psychological brilliance extends to timing and presentation. The system launched during a period of American financial stress when dollar strength depends increasingly on artificial support rather than economic fundamentals. Foreign observers can see Federal Reserve balance sheet expansion, Treasury debt issuance acceleration, and banking sector instability in real-time data. When the alternative system demonstrates superior stability and efficiency during American financial turbulence, adoption accelerates beyond political control or economic manipulation. The cascade effect. Once unit adoption reaches critical mass among major trading nations, the momentum becomes self-reinforcing through network effects that make reversal practically impossible. Countries holding large dollar reserves face a mathematical dilemma: hold dollars that may depreciate as demand decreases, or convert reserves to units that strengthen as adoption increases. The first movers gain advantages that late adopters sacrifice. Businesses conducting international trade face similar pressure. Early unit adoption provides cost advantages and efficiency gains that compound over time. Competitors who delay conversion find themselves paying premium prices for outdated settlement methods. Financial institutions must choose between maintaining correspondent relationships with dollar markets or building capabilities in unit markets. The institutions that develop unit expertise first capture market share from institutions that resist the transition. Even individual investors face portfolio decisions based on currency adoption trends. Assets denominated in currencies with declining international usage tend to underperform assets denominated in currencies with expanding international usage. These individual rational decisions combine into collective momentum that overwhelms policy responses from affected governments. The United States cannot force other nations to use dollars when those nations benefit economically from using alternatives. America cannot prevent businesses from choosing efficient payment systems when those systems provide competitive advantages. The American response problem. The traditional American toolkit for maintaining monetary dominance becomes counterproductive when applied to mathematically superior alternatives adopted voluntarily rather than imposed politically. Military threats cannot stop technological adoption. Economic sanctions cannot prevent efficiency improvements. Political pressure cannot override business incentives when the incentives are large enough and widespread enough. More problematically, aggressive responses to unit adoption risk accelerating the very trends they aim to prevent. Countries that face pressure for using efficient payment systems have additional incentives to reduce dependency on pressure-applying systems. Businesses that face regulatory barriers for cost-reducing innovations have additional motivations to relocate operations beyond regulatory reach. The Federal Reserve's policy options are similarly constrained. Raising interest rates to defend dollar strength accelerates domestic recession and banking failures. Lowering interest rates to support economic growth weakens dollar attractiveness relative to gold-backed alternatives. Maintaining current rates produces neither economic stability nor currency strength. Fiscal policy faces equivalent constraints. Reducing deficit spending to improve dollar credibility crashes an economy dependent on government borrowing. Increasing deficit spending to maintain economic growth destroys dollar credibility through debt expansion. Current spending levels provide neither fiscal sustainability nor economic vitality. The American political system lacks mechanisms for coordinated long-term responses to gradual but persistent challenges. Electoral cycles encourage short-term thinking. Interest groups prefer immediate benefits over structural adjustments. Media coverage focuses on dramatic events rather than methodical transitions. This systemic inability to adapt quickly enough becomes a strategic vulnerability when facing opponents who planned methodically for years and can execute consistently across decades. The global realignment. The unit's success triggers broader changes in international relationships that extend far beyond monetary policy into trade patterns, alliance structures, and power distributions that have defined global affairs since 1945. Countries that adopt unit settlement develop stronger economic relationships with other unit users, creating trade networks that operate independently of Western oversight or approval. These networks become self-reinforcing as members provide each other with goods, services, and resources that reduce dependency on Western suppliers. Energy relationships shift as oil and gas producers price commodities in units rather than dollars. Manufacturing relationships evolve as factories optimize supply chains around unit settlement rather than dollar conversion. Agricultural relationships adapt as food exporters prefer unit payments that maintain purchasing power rather than dollar payments subject to Federal Reserve manipulation. Investment flows redirect from dollar-denominated assets toward unit-denominated assets and hard assets that support unit backing. Capital allocation shifts from financial engineering toward productive capacity construction. Economic development focuses on real value creation rather than monetary manipulation. Military relationships adjust as countries with economic independence develop security independence. Nations that trade in units require less American protection for trade routes. Countries that settle in gold-backed currency need less American guarantee of payment systems. The alliance structures that supported American global leadership depended on economic dependency that unit adoption systematically eliminates. When dependency disappears, alliance compliance becomes voluntary rather than mandatory. The irreversible threshold. Mathematical models suggest that unit adoption becomes irreversible when approximately 35% of global trade settles through non-dollar systems. Current estimates place adoption at 18% and accelerating rapidly. The threshold effect occurs because network advantages compound exponentially beyond critical mass. When enough countries use units, remaining outside the network becomes economically disadvantageous rather than politically optional. When enough businesses optimize for unit settlement, competitors must adopt similar systems or accept permanent cost disadvantages. But reversal becomes impossible, even before reaching mathematical thresholds, because of infrastructure investments and relationship commitments that cannot be unwound quickly or cheaply. Countries that integrate unit settlement into central banking operations cannot easily return to dollar-dependent systems. Businesses that optimize supply chains around unit efficiency cannot rapidly restructure for dollar compliance. The BRICS architects understood this irreversibility principle and designed adoption incentives to accelerate past threshold points before resistance could organize effectively. The dawn of monetary multipolarity. January 15, 2026, marks the end of unipolar monetary dominance and the beginning of genuine currency competition for the first time since 1944. The Bretton Woods system that established dollar supremacy lasted 82 years. Its replacement isn't another monopoly, it's a multipolar environment where multiple currency systems compete based on efficiency, stability, and user advantage, rather than political mandate or military enforcement. This transformation represents the largest shift in global financial architecture since the gold standard ended in 1971. But unlike that change, which concentrated monetary control in fewer hands, this change distributes monetary options among more participants. The world that emerges won't have a single reserve currency supported by military dominance. Instead, it will have competing monetary networks supported by economic performance. Success will depend on providing value to users rather than eliminating alternatives for competitors. For Americans accustomed to monetary privilege, this transition feels like decline. For everyone else, it feels like liberation. The mathematical reality is that both perspectives are accurate. The age of unquestioned dollar dominance ended at 3:47 a.m. on January 15, 2026. What comes next depends on how quickly Americans adapt to competing rather than commanding in the new monetary landscape. But adaptation requires recognition that the change has already occurred and cannot be reversed through traditional policy responses. The unit exists. It works efficiently. It provides advantages that users value more than political loyalty or historical precedent. The revolution happened in silence, but its consequences will echo for generations.